Newsflash, at the end of the day, we're only human. If you remember only one thing about being an investor, that's it. Nobody's perfect. Everyone is fallible. And it's inevitable that we're going to make mistakes. It's just the nature of the business and the nature of humans. That's why if you're going to own individual stocks, you need to follow a set of rules. Rules that are designed to protect you from yourself. Rules that I learned the hard way. And that brings me to my next commandment. And this is a real important one. Never buy a stock all at once. I can't stress it enough. Do not, under any circumstances, buy all at once. Now, no broker likes to fool around with partial orders like I'm telling you to give. No financial advisor has the time to buy stocks methodically over time. The game is to get the trade on at one level in a big way. Make the statement buy. Get the position on the sheets or in the portfolio. But from where I stand, that's all wrong. 100% wrong. You should never buy all at once, and you should never sell all at once. Instead, what I want you to do is stage your buys, stage your sells. Use this term, the term we use on Wall Street is work your orders. Try to get the best price over time, and not necessarily in one day. Maybe multiple days. Why? Okay, when I first started out as a professional money manager, I really wanted to prove to everyone just how clever I was and how right I would be. So if I felt like buying Caterpillar, by golly, I'd buy it now, buy it big, buy it all at one price, because I was so sure I was right. Put me up on 50,000 CAT, I'd scream, which means buy 50,000 CAT, as if I were the smartest guy in the universe. No one could be smarter than I am. I'm doing it big. When I think back about that young Cramer with a mostly full head of hair, by the way, all I can say is that I was one arrogant son of a gun. I was arrogant, and I was wrong. What was my mistake? Well, if you want to buy 50,000 shares of Caterpillar, you don't pick them all up at once. It's really dumb. What happens if it goes down immediately? You'll feel like a dope. Thus, my rule, never buy all at once. Instead, I should have been buying CAT in increments of 5,000 shares. I know it sounds measly if you're a professional, but believe me, I'm right. Buy it gradually over time, trying to get the best price I could. Now, you can put it on a small position and then cross your fingers, hope it goes down so you can buy more at lower levels, get a better cost basis. Now, I no longer trade institutionally, and I know people the institutional guys are saying, Jim, come on, 50,000 is nothing. But you know what? I no longer trade in size, as we'd say, but I still invest, and I invest for my charitable trust. You can follow along at actionalertsplus.com. And whenever we have a new name to tell club members, we buy it in small increments, say 500 shares at a time, or even smaller, over the course of multiple days. It makes sense. When you buy all at once, you're basically declaring that the stock absolutely won't go any lower. Don't you think that's crazy when I say it, right? No one has that kind of insight. Buying gradually in stages is all about recognizing that our judgment is fallible. So why don't more people do it my way? Why don't investors, if they want 500 shares in ExxonMobil, decide to buy it in, say, 100 share increments? I think it's because they want to be big, too. They don't want to waste the broker's time. Your broker wants to get the trade done. I know my brokers hated it at my old hedge fund when I would place incremental orders like I'm describing. But it's just plain hubris to put a major chunk of your net worth into any stock all at once. Who knows? Maybe it'll go into free fall right after. That's why you need to resist feeling like you're making a statement when you purchase a stock. I bought and sold billions of shares of stock. Billions. Do you know how often I got in at the absolute bottom? How often the last price I paid was the lowest and then it was off to the races? Maybe one trade in 100. I'm pretty good at this game. So resist the arrogance. Buy slowly, even buy over a couple of days, as I tell members of the ActionAlertsPlus.com club. Humility beats hubris every time. Next rule, I want you to buy damaged stocks, not damaged companies. Let's say the mall is having a sale and you pick up a piece of merchandise, only to find out that it's broken when you get home. Maybe it doesn't work. Maybe it has a hole in its shirt. In the real world, you can return that merchandise and get your money back. There are guarantees and warranties galore on Main Street. Wall Street's very different. If you buy a stock and it turns out to belong to a defective company, you have to eat the losses. Hey, it's a caveat emptor here, right? It's caveat emptor. There's no money back guarantee. That's why you need to be very careful to distinguish between broken stocks, names that are down for no particularly good reason, maybe some macro cause, and broken companies, which absolutely deserve to see their stocks trade lower without you. Sometimes damaged companies can be easy to discern. When Valiant, the big pharma roll-up, started plummeting from the 200s in 2015, a combination of slowing growth, balance sheet fears, and some chicanery with one of their pharmacies, it wasn't a good sale to rush toward. Valiant tumbled from 262 down to the single digits before it bottomed. A lot of people thought Valiant was worth buying at 150, then 100, then 50. It was like an auction going down. But the ongoing problems at the company meant that the stock was downright toxic. On the other hand, sometimes the stock will sell off for reasons that have nothing to do with the underlying company. It could be caused by ETFs or problems overseas. Washington worries Greece. Just because the stock is down, that doesn't necessarily mean that there's anything wrong with the actual business. So how do we distinguish between a broken company and a broken stock? Complicated question. What I like to do is develop a list of stocks I like very much. I call this my bullpen in the ActionAlertsPlus.com club. When Wall Street throws a sale with the whole market coming down, I use that as an opportunity to pick up the stocks on my list that was designed in a cooler moment with a cooler head. But the bottom line is that you never really know. And that's why this rule works in tandem with the last one. You never buy a position all at once, because what you think is merely a damaged stock might turn out to be a damaged company. If you take your time, you're much less likely to end up with a large quantity of broken merchandise. Stick with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.